G'day folks, and welcome to another Onchain report for the 7th of October. Now, way back on the 8th of May of this year, we released a report called Expecting Chopsolidation. And the thesis there was that the market has been trending upwards for 18 months. We're probably going to have a period of 6 months or so of sideways. Bulls and bears will get liquidated left, right, and center. But if you close your eyes, 6 months later will be the exact same price. And essentially, there'll be traders who have lost money the whole way through. Well, here we are on the 7th of October, not quite 6 months, but pretty close to it, away from that expecting chopsolidation. And I am now no longer expecting chopsolidation. We have a full tank of gas. This chopsolidation process has done its job. And according to my block clock, we wrote that report at 62,000. It is currently 63,200. We are more or less at the exact same price. Bulls and bears have been liquidated. Chopsolidation has done its job. Now, this piece is really a response. There was a couple of comments in Friday's market update where we were looking at whether this correction, this little kind of sell-off that we had was anything to be concerned about. And one of those questions, or two of those questions, was about, can we review the Choppiness Index? Because it seems to be getting to very, very high levels. And those that have been following the newsletter for a while know that this is probably the only technical indicator I spend a lot of time personally looking at. I use a couple of other technical indicators here and there, but for the most part, Choppiness Index and onchain is my bread and butter. It's where I spend most of my time. So for today's session, I want to do a quick review of the expecting chopsolidation thesis. I want to review the Choppiness Index and basically posit a case for why I think chopsolidation has done its job and we're ready to go, and then move on to the sell side risk ratio, which really is a fantastic on-chain partner to the Choppiness Index. So kind of merging the technical and the on-chain side, and when both are speaking the same language, we have confluence, and that gives me conviction. So let's get stuck right into the charts. So to kick things off, let's start with a quick review of the expecting chopsolidation thesis. Now, this was a report we did on the 8th of May. As I said before, the price was about 62,000 at the time. And the thesis was we were probably, after 18 months of upside, probably going to have a period of 5 to 6 months, kind of an equivalent balance, 18 of up, 6 months of sideways. That feels about right. Now, I did cover this chart. I did base it on this chart. I was looking at the Choppiness Index, which is the next one coming up. But you can see that we've been through this process in both of the previous two cycles, and we're in the exact same spot since the cycle low. Super uncanny, really strange. Bitcoin just seems to have this weird cyclical behavior. Now, as a quick reference, I love this instantiation of the chart. You may see these kind of charts relative to the halving, relative to cycle tops. I don't usually look at those too much. I like this one particularly because there's a psychological process and a duration component. The time, the x-axis is really important here. This is the time it takes investors to recover from a bear market, psychologically, mentally, financially. The bear market that you don't see on the left-hand side of the chart, that you can on the right-hand side, it is brutal. Those who've gone through it, you know what this is like. It is a brutal experience. This is the process it takes in terms of time to rebuild conviction, rebuild confidence, and rebuild people's positions for the hodlers to take those coins off the market and prepare for the next leg. Now, perhaps controversially, I do not care about the right-hand side of this chart. In fact, if it was up to me, I would probably actually delete it because it's not really useful. The reason why is we have no idea what's going to happen on this side of the chart, right? In our current cycle, we don't know who's going to bid, when they're going to bid, how much they're going to bid, how frequently. Demand is the great variable. So you will almost never catch me saying, oh, look, the top is going to be on the 25th of December in 2025 or early 2026. I don't care when it's going to be. I don't care what height it's going to be. I don't care about diminishing returns. I'm going to be looking at hodler behavior. When they start selling en masse, then I'll look at the price and then I'll look at the calendar, because ultimately it's that sell side that puts top in, not the fact that it's December or not the fact that, it's diminishing returns or we're 3.48 above this. No, it's when hodlers sell too much. That's what puts a top in. So that will be something we're going to be looking forward to, hopefully, on the road ahead. So the second component to expecting chopsolidation and where it got its name is the Choppiness Index. Now, this is my favorite technical analysis indicator. It's actually the only one that I really use personally and actually base my own personal decisions off. And what I love about this metric, it is non-directional. It doesn't tell me if it's bullish or bearish. It doesn't care. And in fact, this entire report has nothing to do with which direction we go. Subscribers know that my bias is to the upside. I believe that's where we're most likely to go, but put that on the shelf. The metrics we're covering today is purely about how ready the market is to trend. And it's based on this idea that markets cannot go up in a straight line. They rally, they consolidate / correct. They rally, they consolidate or correct, or they sell off and then they have to consolidate or correct and then they sell off, right? Markets trend using a series of rallies, corrections, or sell-offs, corrections, so on and so forth. So the choppiness index, the best way to think about this is it is a fuel tank. When you've got a very, very high value, which by the way, we currently do, and we're looking at this on the monthly basis, this is the big time frame. This is the one that drives the long term, right? When we talk about monthly, all this chop, all that it is doing is recharging the batteries from this massive swing from the FTX bottom to the ETF top. This process, all this daily chop of the ups and the downs and the lefts and the rights, all it is doing is recharging the monthly chart, which looks to me like a bull flag. So on the monthly basis, the idea when we wrote expecting chopsolidation here in, I think it was, here it is, on the 8th of May, choppiness index was very, very low on a monthly basis. This is basically telling you the market has already trended. It's done its job. It's gone from the FTX bottom all the way to the ETF top. It's tired. It needs a breather. It needs to rest. It's going to take some time, right? 18 months of upside, 6 months of sideways. This was the thesis. Well, that thesis is, I mean, as far as I'm concerned, complete. It has more or less chopped sideways for 6 months. If we now stick on the weekly time frame, because this works in all time frame fractals, the weekly is fully gassed up and ready to go. So that means when I look at this assessment, we are ready to trend in a direction, and it is likely to trend for several months. This is not a small trend. When this thing gets going in whichever direction it wants to go, this thing is going to want to move for some distance, right? We are going to trend for several months. Now, those trends are going to have rallies and then sell-offs, and then rallies and then sell-offs, right? It's going to be going both directions. But at the end of the day, if we kind of zoom out in a year's time, we're going to look at this thing and it's going to be multiple months of trending in one direction, right? That's what this feels like it's ready to do. We have a full tank of gas on the weekly and a full tank of gas on the monthly. Now, just note, because the weekly is obviously a shorter time frame, we've had periods where the weekly has fully charged up, but the monthly wasn't there yet, right? On the big time frame, it's still tired. So we can actually trend on a weekly basis to the downside. So we had weekly exhaustion and then it charged back up and then it trended again. We can have weekly swings that is part of the process of recharging the monthly. So the reason that I had such high conviction in this chopsolidation process being a really boring, painful sideways process is the monthly was going to take months to do its job and recharge. And we have done that job. Okay, so keeping a view on like the big picture here, right? We don't care about hourly candles. We're looking at the big story. If we look at the 90-day, the range between the high and the low, these orange zones are highlighting periods where that range is tighter, like a Bollinger Band squeeze. Very, very tight ranges. When do we see this? Well, primarily early bull markets, right? These quiet chopsolidation periods, like a squeeze getting ready to go. We did see it again in 2018. So remember, non-directional, it can go both directions, but this was a 50% down move. This was a rip-roaring bull market from $400 to $20,000. This was a market from $25,000 up to $73,000. So these quiet periods usually result in a serious squeeze. So very, very rarely on a 90-day period have we seen the price this compressed. These orange zones really highlight it. So again, more evidence that he's likely ready to go. Okay, so having established the choppiness index and 90-day, they're kind of technical analysis, and they're in the volatility space, right? They're really telling us we've gone from a period of quiet volatility.